Good morning, good afternoon, good evening. My name is Olawale Daniel as Oladan Forex. Today is different. Today we're going to be talking about the Forex basics and terminologies as the basics and terminologies of Forex trading. We're going to look at what pipes, lots, and leverage is, what you mean by margin and margin call, how to manage risk management 101, and how to understand RRR, risk to reward ratio, and what is stop loss and take profit that we are talking about. That's what today is going to be about. So, first, what is a pipe? A pipe is point in percentage. That's what it means. Pipe means point in percentage. It is the smallest movement in a currency pair price. For instance, you are trading EUR USD. You buy at 1.1000. Immediately it moves up to 1.1001. One pipe has moved up. That's it. For most pairs, the 4 decimal place is the pipe, except for the JPY pairs, because on the JPY pairs, that's Japanese yen, the second decimal place is the pipe. Okay, now what is a lot? A lot is the size of your trade. It means the size of your trade. You can also call it lot size. The bigger the lot, the bigger the profit, and also the bigger the loss. Looking at it, you have lot type, size, and pipe per dollar. The standard lot is 1 lot size. You are risking $10 per pipe. The mini lot is 0.10 size. You are risking $1 per pipe. The micro lot size is 0.01, and you are risking $0.10 per pipe. That you are risking 1 cent per pipe. If you are using a small account, like a $10 to $50 account, start with 0.01 size, lot size. That's the micro lot size. It helps you in leveraging properly, and that's what I'm going to talk about next. What is leverage? Leverage lets you trade more than what you have. For example, if you leverage 1:5, you deposit $10, you can control up to $5,000 in trade size. If you get what I'm saying. Like, now look at the pros. Now the bigger the profit, and the con is that the bigger the loss if you are not careful. But it's best you start with 1:2 to 1:5, but know how to manage risk. Let me explain better. You have a $10 account. You can leverage it using the RRR, risk to reward ratio, that you are risking 1 to get 5, or you are risking 1 to get 2, like that. Like you are risking 60 pipe. No, you are risking 20 pips. Sorry, I said pipe. Pips to get 60 pips. That's it. They are risking $1 to get $5. You are risking $1 to get $3. You are risking $1 to get $2. That's what leveraging is all about. So the next one is margin and margin call. What's margin? Margin is that money the broker keeps aside to hold your trade. And what's the margin call? Your account is too low to keep trade open, then the broker will close your trade. That means you've blown your account. That's it. To avoid a margin call by using small lot size, managing risk, you have to avoid the margin call have to use a small lot size. That's why we should use 0.01 lot size, so you can manage risks properly, so you can avoid margin call from the broker. So what is your stop loss and a take profit? Stop loss is that price level where your trade automatically close in loss. It protects you from a stop out and prevents you from blowing your account. Then what is a take profit? Take profit is where your trade automatically close in profit. For instance, you buy URUSD at 1.100. You set your stop loss at 1.0980, and you set your take profit at 1.1020. You see, it means that you gain you have 20 pips gain and 20 pips loss. That's easy start. That means you are doing 1:1 lot size. What is risk to reward ratio? That's RRR. This is how you compare what you are risking, you see, versus what you hope to gain. You can place your stop loss at 20 pips and place your take profit at 60 pips. That means you are risking 20 pips to get 60 pips. RRR 1:3. Risk $1 to make $3. You see, this is exactly how you aim for a better profit and manage risk properly. At least you can still aim for 1:2 IRR in most trade. That you are risking 1 to get 2. You are risking 20 pips to get 40 pips. That's it. So now, what is risk management? Risk management is the mode at which you manage your capital in your trading account. The means at which you manage your capital, taking your profit little by little, taking all that we've talked about into consideration as you trade. Like the RRR, risk to reward ratio, that you are risking $1 to get how much? $3. If you make profit 3 times, you just make $9. Out of that 3 times, if you make loss once, you lose $3 and you still make $6. You still make profit. It's still a win for you.